Hello, everyone. Thank you for joining our quarterly market update. I am Philip Nelson, and joining me is Andrew Brett, Director of our Real Assets Group. And we'll be spending about 45 minutes to provide a brief macro update, what we've been seeing in the markets, kind of a review of some of our views that I would hope many of you've seen from some of our discussions already in the last quarter. But we're going through some of those, and then we'll wrap up with some questions. Just as a quick housekeeping item, if you do have any questions, please enter them into the text box on your screen, and then we'll go through them at the end and try to hit as many questions as we can. So just to kind of get going, as we look back to Q1, I think it's fair to say that pretty much everything went right. And if we think back time to the holidays in December, at some points it felt like the exact opposite. So in many ways, this was a quarter reversal as equities rallied, rates rallied, spreads rallied, real asset markets rallied, dollar up. So it was hard to find really anything that was down for the quarter. And we have some couple thoughts on kind of what were the main drivers of that, what were some of the main components, and there's some contradictory data out there that we'll highlight as well. But digging a little deeper, just as we look at equity markets in Q1, I think the main items that stand out is the two largest economies in the world, being U.S. and China, really were leaders in driving equity markets forward. And I think a lot of the reasoning behind that probably can be drawn to worries about a recession, both in the U.S. and maybe specific to China, lessened quite a bit and during the quarter. Some of that from just as new data came in, some of it from central bank actions coming out of the Fed, and some of it from stimulus in China. But I think something that we've talked quite a bit about, that there's really two main drivers globally, and that's U.S. consumer demand and Chinese economic activity. And if you see positive shifts or a positive outlook related to those, that should drive markets forward in a fairly robust fashion. And thinking about credit spreads also, this is not necessarily a surprise. If equities are up double digits, we should see a pretty healthy decline in credit spreads. And just looking at broad high yield market and the lowest rated level of high yield in the CCC space, quite a significant decline from year end, where spreads had started to move to areas that maybe were getting a little bit interesting, but pretty quickly moved back to a level where I would think from our standpoint, not seeing a lot of opportunity in credit markets today. What's a bit unusual, I'd say, for a market where you see risk assets rally, typically you would think that positive economic data or inflationary marks are pushing global bond yields higher. And in fact, we saw the opposite. We saw, U.S. yields come in quite a bit, but we also saw, Germany and Japan come in also, and Germany probably being the most, egregious of them. And a lot of that's coming out of, the repricing of economic growth for 2019 and maybe even beyond. One data source that we use is the IMF. This is, something that most global investors will look to. And as we look at what was the forecast for economic growth in 2019 at the beginning of the year, to how is this revised, after the first 3 months. And what we can see is almost across the board, we're seeing downward revisions. And these downward revisions are, most acutely being felt in Europe, with Germany becoming, one of the more exposed. And when you think back to the previous chart on the equity markets, markets did really well, U.S. and China. Growth concerns may be less of an issue now. But we saw equity markets in Europe, specifically Germany, underperform relative to peers, partially because of this global growth revision. The one outlier, as you can see, the green shoot that we have is slight uptick in Chinese economic growth prospects. A lot of that, likely had to do with, some of the stimulus that's been injected into markets, slight add to credit leverage, but also, kind of slight upticks in consumer spending in some other areas in China, which I think in many ways, as we've said before, should we have a global recession, there's likely two sources for where that's going to come from: China and or the U.S. And then as we look at some of the data today, it's not, I would say, great prospects, but it's not bad prospects. So it's kind of pricing in a relatively muted environment, which is not a bad one for risk assets. As we think about some of our key market themes, in some ways, some of the events of the last quarter is a bit of a validation in terms of how we think about our key market themes. For example, China transitions is referencing the big, large evolutionary changes that are going on in the Chinese market and the country itself. And as you can see, if you have equity markets rally strongly in China, you see growth uptick in China. That benefits the rest of the globe, which really references that how important China is. We're really going to focus on two of these themes, being what we call late cycle dynamics, and the other being tightening global liquidity. We'll kind of do a brief review of our late cycle dynamic view, and then highlight on the global liquidity side, an idea or theme that at this point feels pretty impaired. We're going to walk through maybe what part of our original thesis and also what we're seeing today and some of our thoughts going forward. So from a late cycle thesis standpoint, it's a little busy chart here, but wanted to get really a lot of this information out. And we're of the view that the U.S. economy is in a late cycle, and we think of the economic regimes in kind of four groupings. There's an early cycle, there's a mid-cycle that tends to be kind of more an expansionary type environment. And then you have a late cycle, and then eventually at some point that transitions into a recession. And historically, there's a certain subset of indicators that are very helpful in highlighting when or potentially when some of these regimes could shift. And I think what we'd like to highlight is it's incredibly difficult to predict when a recession will occur, and also incredibly hard to predict how severe, how long a recession will be. But historically, there's been some signals that give us some indications of when cycles are beginning to turn. And I'd like to say, just as kind of a hard stop, we really see no evidence in current or financial indicators today that suggest a recession is imminent. But we're keeping kind of an eye and keeping a view to a certain subset of kind of key economic data. So what we've highlighted here is what's the typical trend that we would see in a late cycle relative to these key indicators. So for example, related to unemployment. Up until the recession, unemployment is typically a backward-looking indicator. You see unemployment, falling and eventually kind of bottoming out. We're at very low unemployment levels, but still quite potentially can keep on going lower. Then, for example, markets, equities, often are a early indicator for economic weakness coming. And historically, when you look back to late cycles, you see equity markets peak, which is an early indicator for a recession possibly coming. Now, if we could know when the equity markets have peaked, we would be in a really much better spot to be able to offer investment recommendations. But that's a tough one for anyone to call. The two that kind of highlighted here is one is the yield curve and the other being credit spreads. First I'll touch on spreads. We're thinking about what's been the movement in credit markets over the last 2 quarters. And viewing that as a bit of a trend. And even though spreads have come in quite a bit to start the year, relative to where we were 6 months, spreads are still a bit elevated. So is that one that persists and the market's now pricing in a slightly higher credit concern, or does that keep on squeezing in? Time will tell. The other is in regards to the yield curve. Historically, the yield curve flattens in a late cycle and eventually inverts. Which then leads to a recession many months from that point. During the quarter, we had a slight flirtation with an inverted yield curve at the 3-month relative to the 10-year Treasury yield point. That lasted for 4 or 5 days or so, which for us internally kicked off a lot of meetings, a lot of discussions, a fair amount of healthy arguments, but quickly reverted as markets adjusted. And so as we think about market implications of the yield curve, we're more focused on the 2-year and the 10-year and that differential, and I think many market participants are as well. There's a behavioral impact, and there's also longer term potentially a economic impact that flows through from a flat to inverted curve. And as we've seen so far to start the quarter, the curve steepened a bit. So in some ways you could say less of a concern going forward from now. Switching over to our theme of tightening global liquidity. What we've highlighted here is really almost kind of the original thesis of why did we think we were entering an environment where we would see kind of prolonged tightening and prolonged constraints on global liquidity. And it really came down to 2 main points. First being the Fed in 2018 was forecasting they would be increasing rates over a 24 to 30-month period that was pushing interest rates above what most people would call kind of the neutral rate. And so this, on itself, implies the Fed was communicating a tightening path and communicating a preference for monetary policy tightening. So that's one main component that we look to. The second is the size of the Fed balance sheet. The Fed balance sheet reached a peak of, let's say, $4.5 trillion after the financial crisis, and over the last couple of years has been, steadily being reduced. And we're of the view, and many were of the view, that this steady withdrawal of Fed balance sheet assets had a drain on market liquidity and would have a kind of ever-increasing, almost crescendo in terms of how much it would impact the market's ability to transact, and would have several years out a more tighter effect than maybe people projected. And so for us, it was concern that we saw and talked quite a bit about. The third aspect of what we view as kind of tightening global liquidity is still related to, for lack of better description, kind of the credit pipes and the financial liquidity pipes that exist in the market. So how you trade ETFs, how you trade credit bonds, how you trade options. As bank balance sheets have really pulled back, you still see some liquidity concerns in many markets. So think flash crash, or think really shallow pools of capital when you're trying to transact certain credit instruments. That's a risk that's still very much there. But as we look to what the Fed really did this last quarter, some of the Fed liquidity risks seem much, much less. And the two that we're going to talk a little bit about is the change in the Fed's posture to interest rate changes, and second, their change in the balance sheet, which effectively at September end, the balance sheet will no longer be shrinking and will kind of reach a baseline a little over $3.5 trillion. But like all things, I think a picture is probably worth 1,000 words, and showing some of this, I think, makes the changes a little more clear. So as we look to what the FOMC was communicating in December of 2018 in terms of what they viewed the path of interest rates or Fed funds, you can see that slight tightening being priced in over a 24-month period, including possibly 2 hikes in 2019 and another hike in 2020. Jumping to most recently March and some of the forecast data that came out from them, which we view as an important one, is the Fed forecast of interest rates is important because they're the ones that get to decide where interest rates are going in some ways. So it's a useful tool to get from them. And you can see the big change here, where essentially the number of hikes implied for 2019 went from potentially 2 to none, and maybe 1 hike over the next 30 months in 2020 and 2021. And so this is what the Fed is communicating to us. So you can see, very much backing away from a tightening view. The market reacted even more strongly. And what we have here is the market's expectations of Fed funds. So this is Fed fund futures that date back to end of September, which is the blue line, December, the light blue line, March, which is the most recent data from end of Q1. And essentially, the market's kind of pivoted from a view that rates will be kind of steadily increased over the next several years to one where, if anything, the next action we're likely to see from the Fed is going to be rate cuts. So to have that dramatic of a change in a 2 to 3 month period, going from hikes to cuts, is one that's not unprecedented, but has a big impact on markets. And so when we think about how the markets responded this last quarter, equities up, credit up, bonds up, when you filter it through this theme and kind of this, positive dislocation, it very much makes sense in our minds, the market action that's occurred. The balance sheet being perhaps even more of a surprise to us. We were of the view that there would be several more years of the Fed balance sheet coming in. And if you took projections out to 2022, Fed balance sheet size would be somewhere below $2 trillion if they followed through on their normalization policy. And we've essentially held steady a little over $3.5 trillion. And if anything, as you dig into the details of what the Fed's announced, their holdings of Treasury bonds is actually going to start increasing next year as some of the mortgage securities roll off. So if anything, we have a quarter where we flipped from potential rate hikes to people debating a rate cut to the Fed communicating they're going to no longer be letting bonds mature off, but actually going to have a bigger role in the Treasury market than we had expected for the foreseeable future. So we try not to get too detailed into Fed central bank speak, but I think this is a quarter where the Fed really matters. They really reaffirmed, if you will, almost that Fed put. And we're in the process of evaluating, is this one where it's a permanent change in policy, or is one where if you can change quickly from a tightening to easing view, could you just as easily change back to a tightening view? So we're given some more months to get some extra data in, and we'll adjust our views and themes as necessary as new information comes in. As that translates to what we call our current opportunities, which are really highlighting some asset class actions that we think is present in the market. We'll focus on a couple of them. This is a longer list. Andrew will talk a little bit about our views on midstream. We're really going to focus on these three items. And the first being rebalancing developed market equities. This is not I don't think it's a controversial one, but as especially in the developed world, as equity markets rally, using that as an opportunity to rebalance and adjust exposures. And we've been suggesting using some of these market changes as an opportunity to have a more market weight or index weight when it comes to developed market equity exposure. So if you think MSCI World is a good proxy for developed market equities, a U.S. versus non-U.S. developed weight is roughly in line with views today. The other two being, raising a safe haven fixed income exposure has been in place for about 8 months now. Reducing lower quality credit exposure also been in place for a similar duration. And this gives a sense of where we think some available funding sources for some of these ideas might be. It's a bit binary here. So for safe haven fixed income, sourcing some of the funds from high yields and lower quality credit we think makes sense. And at the same point, reducing credit exposure and redeploying that back into more high quality fixed income we also think is a prudent adjustment. Just to hit on this a little bit more, when we look back to where markets were a year ago, 18 months ago, we're still much higher in terms of interest rates. Markets yields have pulled in a bit, over the last quarter. When we look across the board for what we'd call safe haven instruments, whether it's TIPS, short duration, core bonds, or even high quality munis, the return distribution is not that great. So if anything, a bit of a bias for non-LDI type exposures, a little bit shorter duration than not, and still a view that TIPS have a place in safe haven portfolios for the foreseeable future. And then thinking back to lower quality credit exposure, this is relatively simple, but spreads in many ways are an easy reference to think about what are opportunities to rebalance, add exposure, take exposure off. And as we look at high yield relative to investment grade, a bit of a spike this last quarter where high yields, if it just moved a little bit more, would have gotten a little bit interesting. But it's quickly pulled back in February and March to the point that we're almost back to where we were at the end of Q3 in terms of having a fairly sanguine view of high yield specifically, but I'd say other aspects of kind of lower quality credit. So think even future commitments on direct lending in the U.S. Or lower quality credit exposures, or even lower quality credit within the investment grade space. If you talk to some folks on our credit team, you'll get a fair amount of views and data and related to the BBB space with investment grade as being a concern, and definitely want to reiterate that a bit. So that's a quick hit of kind of our macro outlook, some of our actions we're suggesting for folks. Again, if you have any questions, please enter them into the text box on your screen. I'm now going to turn over to Andrew to talk about real assets.
Great. Thanks, Phil. So, as Phil mentioned, we're going to cover some topics in real assets. We'll start with hitting a quick Q1 performance summary, briefly hit the top-down views that we have on the asset class. I'll do a brief overview on what's going on in the energy markets generally, and then drill down specifics to the midstream space, and then finish with a brief PSA on what we're doing in real estate and some of the themes that we like there. So looking at last quarter, as with the rest of the market, real assets had a really good quarter. So crude oil jumped 33%. Basically, economic concerns were alleviated, and there were some production cuts that supported that. And also, it fell 40% in Q4. So there's still some room to grow there in terms of where we were in Q3 of last year, but that was a positive thing for the energy sector. As you can see, all the energy-related equities also had a good quarter, with midstream energy leading the way with a 22% return. Real estate did well, as Phil mentioned. The Fed tightening sort of slowed down, and REITs had a good quarter. As we think about the world, we haven't changed any of our views from last quarter in terms of our top-down views. We still like certain opportunities in the non-core and the debt space on the real estate side. I'll touch briefly at the end in terms of what we're thinking on the core portfolios. And then on the real asset side, we're still constructive on energy, and we think there's some interesting opportunities in the infrastructure and the renewable space. Midstream energy really bridges that gap between energy and infrastructure, and so that's an area that we're spending some time on. Now, thinking to what's happening in the energy market, you had a price recovery, as I mentioned, in Q1, so oil prices led the way, and the related securities also had a good quarter. But we've seen a disconnect in the oil price relative to the energy securities. You've had a negative sentiment in the industry, so fund flows have not materialized. Long-only investors are still punishing the sector for overspending in the good years and having some bad corporate governance. So the sector still has some cleaning up to do, but we think there's some constructive things going on there. Capital market access has been very challenged over the last year plus. Recent announcement last week that Anadarko had a takeover bid from Chevron really seemed to shake things up a little bit. And then this week it was announced that Occidental was going to come in with a hostile bid above that bid. That might be a nice little precursor for M&A activity to pick up in the space. Now, thinking about the supply and demand picture, and something that we've highlighted a lot over the last 5 years, we've seen global demand continue. So demand globally is really growing at 1 to 2% a year. That being said, there's sort of a mixed outlook going forward. So in developed nations, you're expecting to see a sort of a flattening of demand as folks become more efficient with their use of fossil fuels. But on the other hand, there's still a lot of growth and demand to be seen from emerging markets. So globally, demand's expected to increase, but it's definitely going to be a different look and feel depending on what region you're looking at. As you can see in the green line on the bottom chart, consumption's actually outpaced production over the last couple of years. So you've seen that oversupply kind of be flipped on its head from 14 and 15 over the past couple of years. The reason you didn't see a massive spike in oil, so oil did touch mid-70s in Q3 of last year, but the reason it hasn't really gone to $100 plus, sort of the levels that you saw previous to the 2014 crash, is that we had such large inventories globally. So those inventories have been used quite a bit, and so you've seen the market come into balance a little bit further, but there's still concerns that you could see some oversupply, especially if OPEC and Russia decide to not keep the cuts. So right now, OPEC and Russia are working together to essentially try to keep the market in balance. They've decided to hold those cuts for another 6 months. They're meeting next month. We'll see what happens there. The other bogey that we're really paying attention to is U.S. producers love to drill into these sort of strengthening markets and really preempt any sort of rally by creating an oversupply situation in the U.S. So we're paying attention to those dynamics, but we generally think the supply-demand dynamics, broadly speaking, are pretty healthy. And then lastly, we just want to touch upon geopolitics are driving a lot of the price movement in the near to midterm. So the U.S. just announced last week that all the waivers that were issued to allow Iranian exports to continue, those are being ended next week. So most Iranian supply is expected to come out of the market. Venezuela's supply is pretty low at this point, and other OPEC nations like Libya really have a lot of unplanned outages. This is going to tie into what's going on from a global trade conversation. So I mentioned Iranian exports are going to come to a halt, but that's really not completely true. So the U.S. is having trade talks with China. This all ties in. China buys some oil from Iran on the quasi-black market. You can't really track every barrel. So while sanctions are helpful for keeping some of the economic activity at bay, there are ways that the oil does move, and that's one of them. And so geopolitics is something that we're paying attention to in the oil markets. As we think about the longer-term outlook for oil and gas, broadly speaking, we have to think about the impact of decarbonization. I think it's obviously something that's front of mind for many folks, and whether you drive a Tesla or you think that you have more efficient houses, people are trying to do things that are better for the economy and better for the globe, and so we are looking at that as well. I think our big takeaway is that the overall path to decarbonization is not entirely clear to us. So while Tesla is pointed to as a reason for a lot of oil demand going away, passenger cars are really only about a quarter of the overall demand stack for oil, broadly speaking. And so you have other areas of demand that need to be figured out, and in ways that those boats, trains, airplanes, how will those types of transportation be powered and fueled? So what's going to happen there? Petrochemicals, so how do you get your plastics? You get it's a derivative of oil and gas production. So there are parts of the global supply chain that really depend on oil and gas, and really how can you find substitutes that are economic and really can drive displacement? And so the rate of innovation and adoption is a huge question for us in this. And this is just our way of saying that we get it, we know it's coming, we don't know when oil demand will peak, we know that it will, but it's just not going to go away overnight. And so we're thinking of ways to still deploy capital into the space while being thoughtful around the long-term outlook for overall demand. Now, specific to the midstream space, so this is the artist formerly known as MLPs. We've seen a lot of midstream companies reconstitute themselves and restructure themselves as corporations. So this has been called the simplification. effect here. So basically, MLPs used to have the MLP and the GP, the general partner, and there were something called incentive distribution rights attached to distributions as the MLPs grew. So essentially, the general partners would take a increasing percentage of distributions as their limited partnerships grew. This became a very cumbersome thing for companies as their cost of capital was artificially high because of these payments. And so as a result, a lot of companies essentially had to combine their two entities to allow themselves to operate going forward. And so that, coupled with the change in the tax law at the end of 2017, really created some efficiencies in this structure. And so we've seen a significant number of midstream energy companies consolidate into C Corps. MLPs with IDRs represent about 10% of the overall market cap. And generally speaking, there are ways to invest in the space that do not give rise to UBTI and K1, a lot of the complications that were apparent in MLP investing before, and I'll go into that in a little bit. So thinking about the public opportunity set, this has been a theme for us for about 9 months from a top-down perspective, but we think valuations and going yields look attractive, and more importantly, they look sustainable. So the amount of cash that's going out the door is not handcuffing management team in terms of CAPEX for the projects they're trying to do. We think that they are being prudent in terms of the capital that's going out the door, and balance sheets and liquidity, so cash on hand is improving. From a longer-term growth perspective, so thinking back to that previous slide about when long-term demand is going to roll over and what that path might be, in the near to midterm, there's a pretty strong story in terms of exports from the U.S. for both LNG and oil. So crude and LNG exports are expected to ramp up significantly over the next couple of years. There's demand for it. There's a price arbitrage that other countries can exploit by importing our crude and LNG. And so a lot of infrastructure is being built and will be built to essentially facilitate the delivery of the hydrocarbons from the wellhead to these new export facilities. And so that's going to be a huge amount of production growth globally, and the U.S. is going to account for a lot of it. And so we think the infrastructure story there is pretty interesting. Finally, private investors have taken notice. So you've seen private equity either from a take-private perspective, pure acquisition perspective, or joint venture with operators be the prevalent capital source in the sector over the last 12 to 18 months. They're paying higher multiples than what's being priced in the public side. Now, some of that is they're buying higher growth types of assets, and some of it is there's just negative sentiment in the public side. But as you can see by the bottom chart, we're seeing valuations from an EV to EBITDA perspective really come down, and you're seeing debt to EBITDA get closer to that 4 times bogey that folks really like to look for. And if you cut through it and look at the underlying companies, there's a lot of companies that are below 4x. So why does that matter? It matters because we think cash flows are going to continue to grow. And so there's a lot of CAPEX has been put into the ground by these companies over the past few years. Not all of those projects are cash flowing right now. So you've got some additional revenue on the come from capital that's already been deployed. And further to the sustainable bullet from the previous slide, a lot of this CAPEX has been funded out of retained earnings. So as you can see in the bottom right-hand chart, where MLPs used to send pretty much every dollar out the door to their investors, they're now retaining a significant amount of cash flow to help them fund their organic growth projects. And what you see is typically a 50-50 debt to equity construct on new projects. So they're spending a lot of cash flow that they're generating themselves into these assets and then putting debt on it and having projects that are highly accretive. And so these management teams are able to take that capital and deploy it into high ROI projects, and it's forcing them to really be more smart about where they're spending their capital. And so we think that from the sustainability factor and where those cash flows are going, we like the space. Now, there's a couple of different ways to play it. So we've mentioned the public option for a while now, and so we think the case for investing in the public securities includes the improving balance sheets and the lower level leverage along with the continued growth of U.S. production. We think that the companies with those strong cash flows that have put CAPEX into projects will continue to reap the benefits of that. That being said, we do support an actively managed approach here. We think there will be winners and losers. We think there are still dogs in the space that have either bad assets, bad management team, some combination of the two. So we do think picking a manager who can stock select in the asset class will help you outperform over time. And we think that the ability to invest in companies with a simplified corporate structure alleviates a lot of the headaches for investors, namely dealing with state taxes and K-1s, and then UBTI that would arise from investing in limited partnerships. For those of you that are more private markets inclined, we think the opportunity is also interesting there, mostly because these companies are spending so much time cleaning up their own act that they haven't had as much time to go find new interesting projects. And so the capital-constrained companies in the sector, that void's been filled by private equity and infrastructure, and they continue to try to find new opportunities while all the public companies are cleaning up their own house. GPs have the ability to pick their spots and essentially do deals that they want to do, so you're not forced to do deals in the market. And then finally, if the thesis holds true that the public companies are going to see improving fundamentals, are going to be cleaner stories, and are going to have excess capital, eventually they're going to go on an acquisition spree. And so private markets are going to be there to support that when it eventually happens. And with that, just a quick overview on our real estate views. So no changes here. Two things I'm going to touch on are demographics from a value-add opportunistic perspective, and then what we're talking about from a core perspective. So if you'll remember, we think the core real estate markets are pretty well priced right now. So general consensus is the next 5 to 7 years for returns in core real estate are going to be right on top of what your yield is, meaning that there's going to be very little capital appreciation in the space from a core opportunity set perspective. And so when we're talking to clients about their core portfolios, which may have gotten rather large over the last 10 years, we're talking about ways to potentially become a little bit more defensive. So maybe take some of that allocation and reallocate to debt where you can get yields that are around the same levels of your core real estate book and have a little bit more downside protection, or go the other way and take a look at core plus strategies. So core plus are assets that look and feel like core, but maybe need some light value add, some light lease up, basically opportunities to have the same sort of defensive characteristics as a core portfolio, a little bit more work up front or on an ongoing basis to grow your NOI, but in a way that we think you can grow your NOI in a greater than market and capitalize on the additional capital appreciation that might provide. And then finally, we continue to like demographic-driven sectors. So specifically, senior housing, medical office. The average age of a baby boomer right now, I think, is 65 years old. As baby boomers age, they're going to need more specialized medical care. They're going to need to be put into areas where they want the social aspect. They want to have everything at their fingertips. And so these are demographically driven sectors that are become more accepted by the broader real estate community. They're not the core sectors just yet, but we're seeing more core type of money chase these types of opportunities. So from a value add and opportunistic perspective, we do like that opportunity set.
Great. Thank you, Andrew. We'll take a couple questions now, and also if you have any more, please type them into the question box. Maybe one question that came in regards to kind of thoughts on equities. The question was, within the equities, continuing to rise. The question was, could we be in a melt-up type situation? And this is something that we've discussed quite a bit internally. I'd say the simple answer is potentially yes. As we've looked at kind of a late cycle market environment, we tend to see fairly strong, relatively strong equity markets performing in these type of environments. And I think it poses one of the real challenges of trying to time economic cycles, because there's actually relatively healthy returns to be had in the so-called quote, late cycle. And so in an environment where, the economy is still putting out positive economic growth, signals and indicators are not really flashing red in regards to a recession. It's very much conceivable in line with, equity markets continuing to move higher. Maybe not the scale and magnitude they did this last quarter, but positive for the coming quarters and year or so. Another that came in was related to kind of views on deficits and rising deficits in the U.S. With the changes in U.S. borrowing and increased deficits we've seen, are there any real consequences? Are there real economic consequences? There's been a lot of debate in regards to that of, deficit spending. If it doesn't cause inflation, maybe it can just continue to infinity. That's not a view we would have. We think we're of the mind that deficits do matter. But also, as we think about at some future date, we're likely to see a recession. And if we've essentially, already pulled the deficit spending lever prior to the recession, your ability to mitigate the effects of recession become much less. And as we think about, the Fed maybe pausing rates, not having as much dry powder to cut rates, also in regards to maybe there's not as much dry powder for deficit spending in a recession, it's conceivable that the next recession could be, slightly worse than on average it would be, just because of the lack of kind of dry powder to support. And in regards to the real asset side, we've got another question on kind of renewables for Andrew, more related to, just, as you look with a broad overview of the space, are we seeing a lot of investment opportunities in the renewable sector?
With renewables, we're seeing a lot of funds being raised for the sector, and we're seeing a lot of capital chasing deals in the sector. So we're generally constructive on the role of renewables in the overall power stack going forward. Solar and wind here to stay, specifically solar. There's still some complications around the capital structure and the incentives and the tax equity that go into putting a project together. But overall, the costs have come down to a point where it is competitive with your traditional sources of power, and it's become a state mandate in 37 states, and so it's here. What we are trying to find are the right managers to go prosecute the idea. So all the capital chasing deals in the space has created a scenario where the overall return expectations have become much lower, and so folks are going further up the risk spectrum, so backing developers of projects and using those projects as essentially the collateral for their investment to get those returns that you used to be able to generate with much less risk before. So that's something that we're trying to navigate. And then the other part is just what's the overall return expectation for an asset. So there's a little bit of a time mismatch. A lot of these assets are 30-year assets with 15 or 20-year contracts on them. So there is a levered tail to them. And essentially what you have to figure out is what's the price of power in the out years and what do those cash flows look like to come up with a terminal value. And a lot of the math depends on prices continuing to rise, whereas all the efficiency gains and folks becoming more efficient with power in their houses and their businesses and just generally speaking, U.S. power demand has been flat for the last 10 years. That gives us pause when we think about the assumptions that go into power prices 15 or 20 years from now.
Great. Thank you, Andrew. One last question before we sign off. You mentioned this a bit in regards to the midstream equity views. Any preference in terms of structuring an investment? Would it be primarily C corps, or would you want to mix it with MLPs and C corps? Is a mutual fund preferable versus maybe commingled fund or separate account that can customize things a bit more.
Yeah, so I think, you know, before our view was you needed to take on some of those MLP exposures, and that was just the price you had to pay to get exposure to the space. It seems to us like there's been enough movement in simplifying those structures where we think you can pretty much replicate the investment opportunity without having to take on that structure. And so we're working to find ways to essentially go into vehicles that are only going into the C Corp and basically eliminate a lot of the headache for our investors.
Great. So one last item that we'll just mention before we sign off is a bit of an advertisement for great weather in Boston, and what we're excited about is our client conference on May 7th and 8th. So I'd encourage everyone to register and come join us. We have a really exciting agenda planned over the course of 2 days for it. A lot of work's gone into it, and we think it's a really valuable time spent in terms of what we hope folks will get out of it. So again, we have links on this page. We'll be sending this deck out. It'll also be posted on our website, so nepc.com/insights. There you'll also be able to find the links to register for our investment conference as well. So with that, thank you all for joining. If you have any questions, feel free to reach out to us, your consultant, and look forward to seeing you in early May. Thank you all.